Hey everyone, it is Evan here from the Trade Risk on Friday, February 22nd, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So taking a look here at our market technicals dashboard, you can see we were green right across the week again. Nice strong finish on Friday here, positive right across the board, and some strong 5-day change numbers here for all of the major averages. The Q's lagging just a little bit. Russell 2000 still seems to be out in front and leading. When we look at the major indices versus some key moving averages, we are above everything. Remember, this is total return numbers that are using to calculate the moving averages here, but all in all, some great progress by the bulls continuing to march higher in this sort of road to 2,800 for the S&P 500. We'll talk about that in just a little bit. When we look down here at our market sectors, you can see materials, utilities, which is propping back up here, and technology now rounding out the top three. So a bit of a change this week, some rotation. On the downside, we have energy, the transports, and biotech. So a little bit of flipping going on there, but still overall some pretty constructive numbers up right across the board. And when we look at some of the major markets, we get energy up top, we have natural gas, we have oil, and then we have China and emerging markets for the top four. And on the downside, we have some weakness in the dollar and more sort of unwind in volatility. So let's jump into the charts now of the S&P 500. This is the weekly time frame. This is where we like to start our analysis. Each bar represents 1 week worth of trading on this chart, and in the case of this week, it actually only represents 4 days worth of trading because remember, markets were closed on Monday. This was a holiday shortened week, so if you're looking at volume studies or you're looking at some other aggregate values or indicators for the week's performance, remember markets were closed on Monday. So when we look here at the overall structure, this rally continues, this V-shaped rally off of the lows from Christmas Eve last year continues to impress us all, I think, in the markets. And at this point, we have retraced virtually 100%. We're at 95% retracement of the latest leg down, of that big leg down that we saw, the rollover that happened in the first week of December, right at 2,800, which was followed by, about a 16% drawdown from 2,800 all the way down to the low of 2346. We've put in just about that full retracement. And when we had, prior to putting in a full retracement, we had this series of kind of lower lows and lower highs in place. And that has pretty much been nulled out. I mean, we can certainly roll over here. There's obviously scenarios where this can turn bearish once again, and we can start to leg lower and we can start to see volatility rise. But at this time, given what has happened, the bear case, this intermediate term bear case, has certainly weakened by the fact that we've retraced now all of this move, and we are now coming back into what should be, or what we'd think to be, overhead supply and resistance. In fact, this is where the market struggled for the past, really, it's been below this since September, October of 2018. So it spent a lot of time under 2,800, failing at this level, and we're going to be looking at next week now to see another test of it and to see how the market reacts at this previously influential level. So going into next week, I think that's all eyes on this 2,800. We didn't quite tag it. I think the road to 2,800 still intact. We're still marching higher. It can change on a dime. We could start to see, this market environment stir up and start to rotate to a more bearish environment. But, at this point and over the past many weeks now, a couple of months at this point, it really just, we haven't seen any selling pressure beyond a day, 2 days at most. The sellers just really haven't been able to hold us down with any type of conviction. So coming into 2,800, of course, as we've been saying all along here, it's been hard to chase this market. V-shaped rallies are always very difficult because they always look suspicious and they've always covered a lot of ground in a short amount of time. So it's always a challenge as traders to jump up aboard this rally. And the fact that we're coming back into 2,800 now and testing some prior levels makes it increasingly difficult. But again, when we look at short to intermediate term trends, they are up. So when we look here at the weekly, this is what we're looking at: 2,800 on the upside, 2,600 long ways below us on the downside. Those are the major goalposts that I'd be paying attention to. Above 2,800, we get back up to 2,872. That's about where we topped out in January of 2018, and that's effectively where the steep breakdown started to occur back in October of 2018, September, October of 2018. So let's go down to a daily chart now of the S&P 500. We'll go to the SPY ETF, and we'll just take a look here at the closer trend. And you know what we're really seeing here is this low volatility grind higher. This has come back into fashion. You don't have to go back too far. Think back to 2017 and most of 2016. We had this very low volatility uptrend in place, and that is exactly what we're experiencing now. If you haven't seen the VIX recently, it is trading with a 13 handle now, so it is a far cry away from the 20 plus, 30 plus, 35 plus that we saw just a couple of months ago. We are back now down to a subdued, a historically below average volatility index, and that is present here in the markets. It is the fact that yes, there is complacency out here, but the market is kind of following suit with this low volatility grind higher, and that is the environment that we've been in for the past couple of weeks, and it's in my mind here to stay until it's not. I don't try and predict necessarily when that turn might happen. I don't think it's necessarily possible to do that, or certainly not profitable. Very difficult to do that. So in fact, we just want to wait and observe the conditions in the market. We have this low volatility uptrend, and until it changes, until we get a kind of range expansion lower, break through some support, we want to respect the uptrend in place. Now, remember, 280 or so, we're coming into that level now, so that's what we want to pay attention to next week. Do we get a fourth time failure right here? We failed in October, we failed in November, we failed in December. So is the fourth time the charm, and are we going to break through it at the end of February or March, depending on when we can get up here and test this? That's what's going to be important for us next week. On the downside, really, you could use as a very short-term level Thursday's lows, so around 276.35, very short-term, near-term low here. If we started to break below 276, that might get you a little bit more cautious, neutral in the very short term for you active traders. Otherwise, be looking around 273, 267, some of these prior horizontal lines in here. That's what I'd be paying attention to on the downside for potential support for this market going forward. If we go to the IWM next, we talked about it in last weekend's video, but the Russell 2000 started to really kind of pick up its pace again, emerge as a leader. It's been mostly leading us on the downside in the fourth quarter of 2018, and then on the upside to 2019. It took a little bit of a breather in here where it slowed down as some of the other indices caught up, but then as of last week, this started to accelerate higher again. And just take a look at where the Russell 2000 is in reference to the December high pivot. So again, where the S&P 500, where the Qs, where the Dow Jones, where they all rolled over in December, that first week of December, notice the IWM has already taken that out and is fast approaching kind of the October levels here. It's a slightly different pattern than the S&P 500, but just know, the S&P 500, we're still kind of underneath this December pivot. For the Qs, we're still underneath this December pivot where the market rolled over, or basically right at it. And for the Dow Jones, we are underneath this December pivot. The Russell 2000 is above this prior pivot here. So something to be aware of. Russell was up over 1% this week, continues to be the leader. MACD is making new highs here. The trend, the low volatility grind is higher here until it starts breaking below, several day prior lows, some, shorter term trend lines. It is best to certainly respect that trend, or at least be aware of it. When we go to the Qs, You can see here starting to slow down. This is the index now that is slowing down just a little bit. You can see lots of overlapping trading over the past week or so. It really didn't make up a whole lot of ground this week. It did finish up 0.5%, but most of that time was spent moving sideways. So it'll be interesting here to watch the Qs. If we see some abrupt change of character, maybe it starts with the Qs here. Maybe this is, the one that would telegraph the weakness here, and if we saw some type of sharp thrust breakdown below 170, that would be an interesting development in the market to pay attention to. Not saying it's going to happen. It's not a prediction. It's just an outcome that we want to be aware of. So something I'd be paying attention to next week would be just how this kind of resolves itself. Does it pick back up? To me, the trend is still higher here, so I want to respect the trend and kind of, error in favor of the trend. But I do want to be aware of sort of the slight sluggish performance and overlapping action there back into this December high. So that basically covers the market overall. I think we talked about all the relevant levels. We talked about the VIX back in the 13s, the low volatility grind. Doesn't mean there's no risk out there. Again, don't want to sound like a blind bull at all. I think this, risk can happen fast, but until and if it does, we do want to respect those trends. So let's get into some other major markets here. We'll go to TLT, which did see some volatility this week. It's still sideways in this range, which I frankly enjoy and like because it is setting up for a more potential directional move here. But we had this down move of about 1% for TLT, which is a pretty good move for TLT. But then it kind of recovered here. A lot of the losses back on Friday. So again, a trading range doing what a trading range does, and that is chop around and kind of dance around in both directions. It's still sideways here. I'm watching this 123 and down to 120. That's the 3-point range that I'd be watching. USO. This was a bright spot this week, up over 2%, putting some distance between it and this prior range in here. So about this, $10 to $11.50 range that it spent November and first week of December in, and then basically since the second week of this year, it had spent time moving sideways. It's starting to grind higher now, putting back into more of a retracement. That's going to help support equity prices. It's going to help support S&P 500 and energy stocks and so forth. So as oil continues to retrace, it's also going to help keep stabilization in this market overall. If we see some type of abrupt failure back down into this range, that would catch my attention. Otherwise, short-term trend remains higher. For natural gas, this one here still kind of sleeping. It's trading near its year-to-date lows. Again, not a whole lot else to say about it. I'd really like to just see that fast move above 24.50. Otherwise, I still think sellers in control here. For metals also had some volatility this week. We started off real strong as we broke to new year-to-date highs for GLD. They did pull back a bit into the end of the week. Overall, still constructive, still up 0.5%, but as you can see, the weekly candle not the prettiest here. Maybe some type of exhaustion signal there. We'll have to see if we get follow through. Bulls still controlling the short-term trend, but something to note based on this action this week, whether or not we've hit some type of point at which this market needs to rest or spend more time going sideways. Silver, kind of a similar situation here, had a very strong first start to the week. First couple of days, it ramped up, tried to make new highs. It kind of failed and pulled back into this range. I still own silver. I still have this position on. I like it. I particularly like it above 1480 as long as it stays above there. I think it's, doing some pretty good work and holding up. If it starts to break down really below this 1460 area, that's when we start to get some more problems here. So we'll have to see how the metals act, follow up this week. Both weekly candles there, a little bit of indecision, maybe a little bit less or so in silver than in gold, but we'll see how next week follows things up. So let's get into some of the sectors now. Take a look at top performing and bottom performing. So we got materials on here. This is the number one this week, 3.78% to the upside. You can see we are right back into resistance here, making this one a challenging one to chase. We are back into kind of that December pivot right now. We're below kind of a wall of supply that starts really right around this 56 area. So XLB, nice move this week. Like the increased volume on the upside, but a difficult one to chase as it comes back up into some prior inflection points and overhead supply. Utilities really ramping higher this week as well, 2.72%. That's a big move for them, and it is right back to challenging these prior all-time highs. We are stretching into where we rolled over in December. XLU looks good here on short-term, intermediate-term time frames. We're coming into resistance. We're a bit extended, so once again, like materials, very difficult to chase, but there are some interesting, there always are more opportunities, I think, under the hood when you start looking at individual stocks, get lower risk entry points in some of these sectors, so something to consider if you're looking for allocations there. XLK number 3 here, 2.27% on the week. You can see nice trend, steep trend, but continuing to move to the upside, coming back into some of this prior supply in here from the fourth quarter. Again, a little extended, a little frothy here in the short term. It's up, 6, 7, 8 days in a row. So some strong performance there in XLK, tough to chase. IBB, this was one that we talked about last week. In last week's video, we talked about the impressive sort of look here by this potential breakout. This was last Friday. Said, look, IBB looks good breaking out of this multi-week range. It didn't really get any follow through. It kind of fell back into this range, but then buyers stepped back in and it's kind of dancing around here. May not be ready yet to sort of leave this range, but still overall, I like the save here on Friday. It wasn't just a total kind of failure right back to the bottom end of this range. We did get a little bit of bid here, maybe a little kind of an overshoot retest, if you will. So it'll be interesting to watch IBB. I still like the fact that it's mostly pent up here. It's still pretty actionable versus something like, utilities, which is just, straight line. XLB, straight line into resistance. XLK, very vertical. IBB, little more meat there to potentially, pave the way for some type of move. XLE, second bottom performer here, little up over a little 1% or so, stalling out just a little bit. USO had a good week, but XLE coming back into some prior supply here, taking a little bit of a break. It's still holding its relevant trend, so overall I still give credit to the bulls there. And Staples up 1% this week, coming into some overhead supply, some volatility zones here. This is where it started to kind of accelerate lower back in December. This is definitely a different looking pattern than many of the other indices, sectors, major averages. So XLP coming back to sort of the scene of the crime here, putting in a pretty sizable retrace off of the lows. Doesn't really speak too much to me though. No real trade setup I see here. Looks kind of messy. It just extended, and quite frankly, if you're not involved in it, I don't see too much of a reason to get involved in it, but that's just me. Again, individual components certainly going to have some more opportunity. So that is the recap. That is what we have for this week of February the 22nd. Going into the last week of February, we'll see how we shake up as S&P 500 tests 2,800 and some of the other major averages test those December pivots. I think that's it. So thanks so much, as always, for watching. You can subscribe on our YouTube channel, keeps you up to date with all the latest videos, or follow us on the blog, traderist.com/blog. Have a great weekend, and talk to you all next week.